In this week's video, we'll review the latest charts and data to help us answer the question: normal stock market correction or the early stages of another record plunge? Since some of the commentary in this week's video was recorded before the close on Friday, September 18th, I want to kick off the video with some summary slides that include data from the close on Friday, September 18th. This is the S&P 500. Basic message here: the commentary in the video still stands. Closed above the big gap here, did not enter the small gap, came close to it during Friday's session, and also closed above it. We can draw a trend line here that attaches this high and this high. If we drag it down, markets tend to like symmetry. We came down to that trend line intraday on Friday and bounced. Doesn't mean the trend line is going to hold, and it doesn't mean either one of these gaps are going to hold. Thus far, the lower end of these gaps are still in place. The same comments apply to VGT, VUG, and QQQ. All of them went back into the gaps that we talk about in the remainder of the video and bounced on Friday, and all of them closed above the lower gap in this area here. Thus, the message in the commentary that follows still applies. For reference purposes, many of the charts that we covered in this week's video, this table here shows you how they performed on Friday and how they performed for the full week. All of this aligns with the commentary that follows. No material change based on the weakness in Friday's session. These are all charts that are important and/or that we cover later in the video. The purpose of showing them, all of these charts are as of Friday's close on September 18th. Once again, no material change to the commentary that follows. Also, as of the close on Friday, September 18th, it had been 11 trading days since the stock market peaked on September 2nd. JNK high-yield bonds relative to TLT over the last 11 trading days, number one, they've both lost money, and they're basically running neck and neck. How does that compare to the credit markets or concerns in the credit markets 11 trading days following the February 19th peak? Present day is significantly different and significantly more tame on a relative basis. 11 trading days from the February 19th peak, TLT outperformed JNK over that period by 11.4%. Current period, 11 trading days, JNK is actually beating TLT fractionally. If you prefer IEF relative to JNK, we use both. Similar story. If you purchased IEF at the close on September 2nd when the S&P 500 peaked, it really hasn't helped you that much. IEF has lost money over that period. That is radically different relative to the 11 trading days following the S&P 500 peak on February 19th. Nice return if you owned IEF over that period. And the spread between the two here, significantly more fearful, 7.49%. Again, these are almost running neck and neck. IEF has lost a little bit less than JNK. This speaks to the net aggregate opinion of all market participants 11 trading days after the peak. This also speaks to the net aggregate opinion of all market participants 11 trading days after the peak. It's a daily chart of the VIX, affectionately known as the Volatility Index. Covered this last week. This is a chart dated September 11th. We basically said if you're a stock market bull, all things being equal, you would prefer to have the VIX stay below this downward sloping line here. We experienced some volatility in the S&P 500 this week, including a drop of 28 points in the stock market on Thursday, September 17th. Despite that drop, the VIX stayed well below the downward sloping trend line we talked about last week, and the VIX was up less than 2% on September 17th. We covered the chart on the left side of the screen and the right side of the screen in last week's video. We said the VIX really wasn't screaming imminent Armageddon. How did that work out Monday through Thursday of this week? Not all that bad. As of Thursday's close, the S&P 500 was still up 16 points. The NASDAQ, despite weakness on Thursday, was still up 56 points for the week. And the Monday through Thursday tally for the Dow, a gain of 236 points. Also covered this chart last week, so basically everything that we said about this chart for the most part still applies this week. How can that be? This chart was dated September 10th. The S&P was up 1 point on the 11th, so very little change. If we fast forward to Thursday, September 17th, roughly a week later, the S&P was 18 points higher relative to the chart we covered in last week's video. Hard to say that represents significant deterioration. Here's a chart of the AIRLINE index, XAL relative to SPX, that we covered in August. This particular chart was dated August 20th. We said all things being equal, we would prefer to see XAL relative to SPX break above this downward sloping trend line here. This week, September 17th, we are above that downward sloping trend line. And this is a relative chart. This is XAL over here in isolation. Since the March 20th close, March 23rd was the first day of the rally, XAL in isolation has rallied nicely. And even on a relative basis, this is March 20th close here, the ratio is higher than the March 20th close. We've had a failed breakdown and a failed breakout. Still some work to do here, but this definitely isn't jumping up and down bearish at this point. Last week, FDN relative to TLT. September 17th, this week, some noticeable deterioration. That's the bad news. The good news is the ratio is still above the high from Q1 of this year. Probably fair to say this still falls into the indecisive category. Triple Q's chart covered in last week's video. It's dated September 11th. If we look at the same chart this week, September 17th, bad news is we really haven't rallied significantly. Good news is we're still holding above the gap that we covered in last week's video. The gap is shown here with the dotted lines. September 8th tweet said the S&P 500 had closed near this big February gap, and the market would decide if the area was relevant or irrelevant. This week, September 17th, we are still above that gap. The February gap, you remember, is the big gap. This was the small gap that we covered in last week's video. As of September 17th, we are still holding above the small gap. As of Thursday's close, September 17th, the S&P 500 was 73 points above the top of this gap, denoted by these lines here, and it was 85 points above the lower end of the gap. Here's the look of the charts that we covered in last week's video showing similar gaps. September 17th, triple Q's went back into the gap but closed above the gap. NASDAQ went back into the gap, closed above the gap. VGT went back into the gap on Thursday, September 17th, and closed above the gap. The S&P 500 has not yet revisited that gap. All three bullet points that we covered last week still apply. September 8th tweet after the close, 4:02 p.m., said the S&P 500 was testing this upward sloping blue trend line. Really don't have a decisive resolution one way or another, but it's probably fair to say we really haven't broken down in a bearish manner, and even if we did, there are still 6 other areas labeled on the chart that could act as potential support. Still somewhat of an indecisive look, but we're in a bullish trend, and this really hasn't broken down in a meaningful way as of the close on September 17th. Maximum flexibility, 100% of the time. After the close on September 10th, we showed this look right here of bonds IEF relative to SPY. How does the same chart look today? Not materially different. That tweet came on September 10th. This chart is dated September 17th. Since then, SPY has outperformed IEF, so it's hard to make the argument that this chart made significant progress in IEF's favor. Still an indecisive pay attention look, but the trend has favored SPY. There's nothing decisive here yet telling us that it's starting to shift convincingly towards IEF. That may change, but it hasn't changed yet. Similar situation here. As of Thursday's close in the Twitter feed, you can find the tweet. Long-term Treasury bonds lagging SPY for the week. Long-term Treasury bonds were lagging tech stocks for the week. And as of Thursday's close, long-term Treasury bonds were lagging the equal weight S&P 500. Just as these stats tend to lean bullish/patient, if they flip the other way, we'll learn something in a bearish manner. That may happen soon, but it hadn't happened yet as of Thursday's close. You may remember in last week's video, we said home builders relative to bonds TLT. This consolidation is below the downward sloping trend line. This consolidation is above. This week, ITB, as of Thursday's close, was beating TLT by 1.78%. Still above the downward sloping trend line. Triple Qs relative to GLD. This is the chart that we covered in last week's video, dated September 11th. This is a weekly chart as of Thursday's close. QQQ slightly underperforming GLD Monday through Thursday, down in the ratio 0.33%. We'll see what happens on Friday, but really don't have any resolution here either. Another indecisive, maximum flexibility type look. And as we've said in the past, looking at this from both a potentially bullish and bearish perspective for stocks can be healthy, because we always want to keep an open mind about a wide range of outcomes. You might remember last week we said we'd like to see this gap close. And we said between August 6th and September 10th, SPY was closing the gap a little bit, outperformed GLD. This is as of September 10th. Similar situation as of September 17th. Still outperforming physical gold, trying to close this gap a little bit. At least this isn't getting worse, it's getting a little bit better relative to the stock market. And nothing says in a bull market that we can't own both the S&P 500 and gold and make money. We outlined the potential concerns in last week's video. Here's the chart that we covered last week. Here's the gap between the S&P 500 and physical gold. As of Thursday's close this week, over those 4 trading sessions, it was closed a little bit. The S&P 500 was outperforming physical gold by 0.38%. We covered this chart in detail last week. As of Thursday's close, really nothing has changed. Why is that? We covered the chart when the S&P was at 3349, and this is your basic potential area of support. The market closed higher than that level on the 17th, so this support area was still holding. The close on September 17th was 3357. This close here on this chart was 3349. Therefore, everything that we talked about in last week's video relative to this scenario, and this scenario still applied as of Thursday's close. Equal weight technology this week, still an indecisive look, but still holding above the upward sloping trend line. This is your indecisive area here. Similar situation here. This is last week. Equal weight technology relative to IEF or bonds. It's a daily chart that we're looking at. Monday through Thursday, RYT was beating IEF by a sizable margin, 2.29%. So this chart didn't get worse this week. As of Thursday's close, it looked a little bit better. SCHX stocks relative to bonds, IEF. This is the look of the chart last week. Here's the same look, daily chart, September 17th close. This is a daily chart, but the weekly chart, SCHX, which is very, very similar to SPY, beating IEF Monday through Thursday by 0.94%. Similar situation here. This is the chart that we covered last week, our indecisive area of potential support. This too is a daily chart. This week, Monday through Thursday, SCHG growth stocks outperformed TLT or longer-term treasuries by 0.54%. Like most of these charts, we'll learn something relative to bullish probabilities if this ratio can right itself and move in this direction. We'll learn something about bearish probabilities if it moves in this direction. And in both cases, the longer it stays above or below, the more relevant it becomes. You can find this table here in Ryan Dietrich's Twitter feed. It comes from LPL Research. They noted that the S&P 500 had now closed 100 days above the 50-day moving average. We wondered, in similar cases dating back to 1984, when something like that happened, how did the stock market perform walking forward relative to the bond market? Therefore, we took these dates and performed that study. This is the performance of bonds, VUSTX, walking forward from these dates. It summarizes it. This is the S&P 500 walking forward from the same dates. This is the NASDAQ walking forward. For clients, it tells us a similar story to the other studies that we've conducted. Don't be too quick to dismiss stock leadership, and we should be very, very open to increasing our bond exposure over the next 1 to 2 years. It's a chart of the Dow that we covered in last week's video. We said this area here, the June high, was relevant. Also, these gaps in here. If we fast forward to the close on September 17th, still above the dotted blue line and still above the gaps. Last week, we talked about the S&P 500 over here. Earlier in the year, hot knife through butter relative to all these moving averages. If we look at the same chart as of September 17th this week, this is not a hot knife through butter look yet. That may happen soon, but it hasn't happened yet. Triple Qs relative to bonds, a chart that we covered earlier this year. This one's dated August 20th. This is a weekly chart. Last week we said this was concerning, but we said for the most part, we could say this is a bullish breakout and this is a retest. Retests can pass or retests can fail. How does the same chart look this week? As of September 17th, a slight little bounce in favor of QQQ, up 0.2% for the week. But the most important thing is we do not have a failed breakout look yet. Once again, that may happen, but it hasn't happened yet. Trade the chart in front of you. Trade what is happening rather than what we think may happen. In its present form, this chart tells us to pay attention, but it also tells us to be open to better than expected outcomes. This big area of white space here tells us to keep an open mind about worse than expected outcomes. We originally started talking about JNK relative to TLT from a specific perspective back in August. And last week we said, since August 20th, JNK had slightly outperformed TLT. Not particularly alarming. How about after the volatility this week? Similar situation, not particularly alarming. So while the market was volatile, especially on Thursday of this week, over the last 4 sessions, JNK has outperformed TLT. Once again, this may change soon, and it may change rapidly and violently, but it hasn't changed yet. We'll see what Friday brings, and what the following week brings. Day by day, maximum flexibility. The week of September 11th was also a very volatile week. Remember in last week's video, we said this was probably a good sign here. XLI, which has been a laggard, was trying to break out above RSP, another laggard. As of September 17th, this chart looks even better, and the breakout is holding. August 20th, economically sensitive transportation stocks relative to the S&P 500. It was below the downward sloping blue trend line. Last week we said there's been a lot of volatility in the stock market, but this is a sign of a rally that's trying to broaden out. This is September 11th. What happened this week? Chart improved even more. September 17th, we are further away from the downward sloping trend line. The longer the breakout holds, the more relevant it becomes. This breakout, like any breakout, may, even if it holds, have to have some form of a retest. Thinking in binary terms near trend lines can be dangerous. The longer you're on this side, the more relevant it becomes, and the longer you're on this side, the more relevant it becomes. Anything more than that is simply guesswork. Last week we said since August 20th, SP low volatility had underperformed SPY a little bit despite the recent volatility. This week, Monday through Thursday, once again, SPY outperformed SP low volatility. This doesn't look like increasing fear or maximum fear during this period of volatility. May change soon. Hasn't changed yet. We'll learn something either way. This was another chart. Last week we said things were volatile, but this is a subtle reminder that it might not be as bad as it appears. This is RSP, the equal weight S&P 500 on September 11th, trying to clear this downward sloping trend line. This looks like a breakout, a retest, and a move in this direction. This is not a major shift. This is a subtle shift. If we fast forward to the same daily chart as of the close on September 17th this week, it has improved a little bit. And on a weekly basis, once again, despite the volatility that we had Monday through Thursday of this week, RSP has outperformed SPY by 1.41%. Once again, telling us this could be a healthy broadening out attempt for the rally. A look like this does look like rotation. And during a bull run, rotation can be healthy and it can enable the bull run to continue. Like many of the charts that we've covered this week, there are some subtle differences. As of Thursday's close, they're saying there's no major damage to the bullish case. It may be on the ropes, we may be near an inflection point, but the chart in front of us, as of Thursday's close, for the most part with equities, was still calling for patience. How long will that last? We have absolutely positively no idea. That's why it's important to head into next week and every week with that flexible, unbiased, and open mind so we can continue to trade the chart in front of us in an effective manner. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.